Finally, KCS has agreed the deal with CP and CN has to pull out of the deal. If you have to invest money in CN or CP rail, which one would you choose? Let's compare both these historic Canadian railway companies. Hi, welcome to another video on Canadian dividend investment. In this channel, I talk about the Canadian dividend and growth stocks, mostly focusing on how we can make the money do the work for us and provide a second income. So if you have not subscribed to my channel, please subscribe. That will help me a lot. If you like my content, please like my videos and share your thoughts in the comment section. Today, we're going to talk about two historic companies. Country's largest railroads, CN Rail and CP Rail. So I'm making this video a two-part series. In the first video, I will talk about CN Rail, and in the part 2 series, it will be CP Rail, and then we will compare some of the fundamentals of the two companies. Canadian National Railway is Canada's largest railway in terms of both revenue and the physical size of its rail network, spanning Canada from the Atlantic coast in Nova Scotia to the Pacific coast in British Columbia. They have over 19,600 mile network which spans Canada and Mid-America. CN Rail offers fully integrated rail and other transportation services, including intermodal, trucking, freight forwarding, warehousing, and distribution. They have a workforce of approximately 24,000 railroaders and transports more than Canadian dollar 250 billion worth of goods annually for a wide range of business sectors ranging from resource products to manufactured products to consumer goods. CN became public in the year 1995 with an IPO price of Canadian dollar 2.25, that is a US dollar of 1.67. Out of its revenue, 25% is from shipping intermodals, 21% from petroleum and chemicals, 16% from grain and fertilizers, forest products, minerals, automotive, coal, etc. are other commodity groups. So in short, it is a very balanced, diversified portfolio. From an investor perspective, we need to understand how the company is doing. The best place to start is from the company's financial statements. I'm using yahoo.com for that. Balance sheet, income statement, and cash flow statement will give us some really good information. So let's dive straight into the first of the three, the balance sheet. The thing I mostly check here are total current assets, which are the assets that can be turned into cash within 12 months, total current liabilities, which are the liabilities that needs to be paid within the next 12 months, total assets, total liabilities, and stockholders' equity, which is the difference of assets and liabilities. So if you look here, the total current assets and total assets increase year by year, which is a very good sign. Total current liabilities, on the other hand, is like first decreased from previous year and then increased and then again decreased. I won't say this as a trend. There may be a lot of reasons why this may be happening. Another row that you can check here is the current debt. It has decreased considerably from 2017 to 2020. That is a very good sign. Another such good sign that we see here is net receivables versus accounts payable. Net receivable is always greater than the accounts payable year after year. However, I'm kind of surprised with all these green signals on the balance sheet. Why does the total current liabilities is always greater than the total current assets? What I do normally is I divide the current assets by current liability, and if it is more than 1, I consider it as a very good balance sheet. Now, if we look at non-current liabilities, the long-term debt is keep on accumulating. There was a big increase in 2018, but after that there is no major spike, but consistently increasing from 8 billion to 11 billion in 2020. Note that we are talking about a freight transportation company. So the amount of debt we see here is not actually a big number. Having debt is fine. We can't run a company without that. The end result is that matters. That is the stockholders' equity. This shows whether the company is losing money or not. And here it has also consistently increased, which again shows that the company is not running in loss. Income statement displays the profitability of the company for the period of time. If we look at the total revenue and gross profit, which is the revenue after all the expenses, the company did well except the year 2020, where we see a decline. This may be related to COVID. Now, in Yahoo, the total operating expenses is showing as zeros for all years. That is not possible, right? So I looked up the income statement on CNRail website for the year 2020. And this is what I found. For year 2020, there is around $9 billion of total operating expenses. So this means the operating income showed on Yahoo is not correct, or in fact, they failed to show it. Total operating income as expected is less in 2020 compared to 2019 and 2018. And if we look at the fuel expenses here, we can see that it is less in 2020 compared to how it was in 2019 and 18. And yes, price of fuel may be one factor, but I also suspect because of COVID and lockdowns, it may have impacted the train schedules and number of trains ran during that period. And the same trend we can see in the net income as well. And this net income has been correctly captured in Yahoo. So we can calculate the profitability margin by taking the net income and dividing by the total revenue and multiplying it by 100. So the profitability margin for CN in these 4 years and the current trailing 12 months is as. This does highlights that the profitability of the company went down from 42% in 2017 to 30% in 2018 and to 28% for 2019. The last 12 months, however, we see a slight improvement. But overall, this is not a promising sign. We may have to compare this with CP Rail's numbers to come up with a decision. The same pattern does shows up in the diluted and basic EPS as well. The third document that I'll be referring here would be cash flow statement. This financial statement explains how much cash has come in and gone out in a year. It also shows the source of these cash flows. As you may be aware, cash flow has three major sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So for cash flow from operating activities, I normally don't go in detail, but just looks at the trend. In this case, we can see that the trends look positive. This is the money that company has received from its operations. Now we have to look at how the company is spending this money. First, investing activities. Majority of this cash company has invested in itself, either by buying new locomotive or expanding the plant or improving the yard, which all is a very good sign because company wants to upgrade. For new acquisitions, this year company spent around $916 million. Now under financing activities, the major amount spent is on dividends. But also in 2017 and to 2019, company has been buying its shares back considerably. As long as the company has the money to do it, that is fine. Recently they have reduced that and using the money for something else. But overall, if we look at the net change in cash, it is a positive amount, which means the difference between the cash received from operation and the cash spent on investment and financial activities is a positive number. In 2019 and 2017, we have a negative number though. And if we look at it closely, in 2019, there was a high amount spent on investing activities. Whereas for 2017, there was an increase in financial activities. So I'm not concerned about that. It doesn't look odd and it's not like company is overspending every year. and so not a red sign for me. So overall, from a cash flow statement, there is nothing that sticks out which I'm concerned about. Comparing all these statements with CP rails will give us a better picture on selecting one over the other. Since we covered most of the details about CN rail, let's look at CP rail. That will be in the part 2 of the video. I will update the link in the description and also on the end screen. Thank you for watching, and please don't forget to watch the part 2.